All right. So next topic is SOFR futures. So as I said, right, CME started listing SOFR futures on their website. Today it is extremely liquid. Okay. Everybody is using SOFR futures for trading, speculation, and hedging, obviously. So back in the day when we had LIBOR, how we used to construct yield curve is typically we relied on euro dollar futures for the short end of the curve. So from 0 to 1 year, that part of the curve, we used to rely on euro dollar futures, which was very liquid. Same thing. So now the equivalent of euro dollar futures is SOFR futures, 1 month futures, 3 month futures. Okay, so we use that to construct the short end of the curve. So we'll talk about that later. All right, so CME has these two popular futures. One is 1 month SOFR futures and then 3 months SOFR futures. Let me quickly take you to their website so you can have a look at it. Give me a second. Sorry. Okay, so if you go to CME Group website, they have the 3 month SOFR future quotes. You can see different futures and the last traded price, change, high, low, volume, etc., etc. Right, and then parallelly you have 1 month future quotes. Okay. So this is their website. There are a lot of good resources on CME website. I would highly recommend to go through those. So let me explain to you the basic valuation of SOFR futures. Before that, we need to understand the nomenclature. Okay. So how do we read the SOFR future? There are two things. One is called product code, which is either SR3 or SR1. SR3 means 3 month future. SR1 means 1 month future. This is the complete ticker description as we saw on the website, right? This is how it looks like. The second part, H3, M3, U3, that denotes the contract month and year. Okay. For example, H3 means March future. 3 would correspond to the year, so 2023. So in the website, for example, right now we have, if you see this one, March 2025 future, right? It is the ticker is SR3H5, H for March and 5 for 2025. Okay, that is how we read it. All right, now let's talk about some of the valuation. As I mentioned, right, earlier we used to have euro dollar futures, which was USD 3 month LIBOR futures because the futures reference the LIBOR rate. Okay. All these yellow ones refer to LIBOR. So that is now extinct. Now we have SOFR based futures. We'll talk about SR1 and SR3. We have contract size and contract month period. So 1 month future is for 1 month, 3 month future is for 3 months. Tick value basically means if there is 1 basis point change in the underlying rate, what is the change in value of the notional? Okay. And whether it is, how is the rate calculated? Is it geometric or arithmetic? So as I mentioned, right, geometric is the most popular convention, but arithmetic is used as part of 1 month future. Okay. So 3 month future uses geometric rate, 1 month future uses arithmetic rate. All right. How do we calculate the tick values? It's very easy. Let's go here. First, let's understand the relationship between price and rate. Okay. The price of a SOFR future is the simplest imaginable equation. It's just 100 times 1 minus R. Okay. R is the rate. Simple linear relationship. There is no complications or anything. Sometimes you'll see 100 minus R. But in that case, the R is quoted in percentage. Okay. So, or you can use this, same thing. So let me show you the website. So here, if you see, the last price is 95.645, right? If you do 100 minus this, you get the rate. It will be 4 point something. That's the 3 month rate. But between which two dates? It's a 3 month rate, yes. Starting from March, April, May, June, March to June. What are those dates? Let's talk about that. Okay. Yeah. So price Formula is easy. It references the underlying 3-month rate. Price is just 100 times 1 minus R. Let's talk about the tick value that we saw, right? $25. $25 is the tick value for 3-month future. 41.67 is the tick value for 1-month future. How do we calculate that? It's very easy. It is basically the change in the future value of the contract for 1 basis point change is the underlying reference rate. Okay. Tick value is contract size times the contract period times 1 basis point change. Okay. So let's do that calculation quickly in Excel. Right. First and foremost, let's say if the underlying reference rate is like 1.75%, price would be the one that you saw on the website would be 98.25. How did I calculate that? 100 times 1 minus R. As simple as that. Okay. If this is the 3-month rate, this is the price. Now let's talk about the tick value. So for SR3, the contract size is 1 million. If you see, the contract size is 1 million. Contract period is 3 months. Tick value is 25, and that is simply calculated as this. Contract size 1 million. 3 divided by 12, that is the year fraction for the 3-month period, times 1 basis point. That is $25. That means if the underlying rate moves by 1 basis point, then the change in the contract value, if you have bought one contract that has a notional of $1 million, the change in value of your position would be $25 for 1 basis point change, right? It's a perfect linear relationship. Simple question, is it inversely proportional or directly proportional? The rate and the price. If the rate goes up, does the price go up or go down? Sunil says it is inverse. Everybody agrees it is inverse? It is inverse, right? 100 times 1 minus R, so it is inverse. So if rate goes up, your price goes down. Okay, so as long future, if rate goes down, then you benefit because your position will go up. Okay, so that's tick value. All right, now let's talk about, similarly, you can calculate so I'll leave that as an exercise. This one for 1 month future, it will be $41.67. I think I have it as dynamic. Yeah, it's the same calculation. Okay, so this is important. How do we, when we say 3-month rate, right, for a particular SOFR future, what are the dates? What is the start of the contract period? What is the end of the contract period? Okay, so for 3-month future, let's look at this particular product, which is SR3M3. Okay, M3 we know is, let's say, 2023. What is M? M is, let's go to the product code. So M, you can see, is June. Okay, so this is a June contract. We have something called as contract month and delivery month. June is the contract month. Delivery is after 3 months, which is in September. Okay. Now, what are the dates? The dates are called as IMM dates. IMM dates. IMM dates are nothing but the third Wednesday of these quarter ends. Third Wednesday of these quarter ends. So June is a quarter end, right? The third Wednesday is 21. 21st June, that's the third Wednesday. That is when the contract, that is the start of the contract. The end of the contract again, third Wednesday of after 3 months. So September 20th is the contract expiry. Okay. The last trading date would be 1 day before that. So 19th September is the last trading date. From a settlement perspective, you have to take all the rates that are published from 21 till 19th, do a compounding, and that will determine the final settlement price. I will show you the calculation. Okay, but please just understand that how do we infer they call it as a reference quarter, right? Because it's a 3-month period. How do we infer the start date and end date? It's the third Wednesday of the contract month, including that date, okay, inclusive. And third Wednesday of the delivery month, which is exclusive. We don't include 20. Okay, the last trading date is still 19. So that is what you have to remember. Now let's, okay, so let's do a quick calculation. I'll show you how to come up with the final settlement price. Yeah, easy, straightforward, okay? So every day, so the same example I have here, let me zoom it a little bit. Starting from 621, right? Remember, that's the first day. 621, some SOFR would be available, published by Federal Reserve Bank of New York, but that publication date would be one day after. That's fine. Just keep this in the back of your head that you get to know the rate only after the next day, but that's okay. This rate is applicable for this for 621, 5.05%. So every day you have these SOFR rates until the 19th September. That's the last rate that you need to complete the calculation. And it's the same compounding formula that we just talked about, right? When you reach this date, on 19th, you will not see this. On 20th, you will see this, right? And that is when you're due for settlement, okay? The rate is simple, just compounding that we just talked about. So how will calculate this? It is product of 1 plus R tau, right? Tau is the day count fraction. Again, day count fraction, you remember how to deal with, right? For weekdays, it will be 1. For holidays, it might be 3, might be 4. For example, this is a peculiar case. See, for this Monday, right? It was a holiday. So the next day was Wednesday. So the Monday rate, which is 5.06%, carried over for 2 days. Special holiday. So anyway, so you just do the same compounding calculation that we did. So if you look at this formula, product of this is 1 plus R times D by 360, all of these, minus 1, annualize. 3 times 360 divided by total number of calendar days. Total number of calendar days will be typically 91 for 3 months. Okay. So if I just highlight this, the sum is 91, right? So for 91 days, you calculate the compounding factor, then calculate the interest and annualize. This I hope is 91. Yes. And you get the rate 5.239, whatever it is. Next step is to round it to 1/100th of basis point. And this is my final settlement rate. And your settlement price is 100 minus that. 94.7604 is your final settlement price. Any questions? This is based on pure geometric compounding that we just discussed. That is how the 3-month future settlement happens. Okay, if no questions, let's move on to the next product, which is 1 month SOFR future. Before that, let's quick touch upon this idea. We actually discussed this earlier. So here's the thing. When let's look at one example. Actually, that will help. So for example, this is interesting. If you look at say the June future SR3M5, okay, this will span from June to September, as we just saw. But today is what day? We are in the month of May, correct? June has not happened yet. The whole contract is in future. Start date T1 is June 3rd Wednesday, whenever that is. That is T1. T2 would be September 3rd Wednesday, whenever that is. Both T1 and T2 are in future because today it's May, right? We're not there yet. So the rate that is inferred from the June price, which is 100 minus this, 4.19%, right? That 4.19% is the rate between June 3rd Wednesday to September 3rd Wednesday. It's a forward rate, right? So it is a pure expectation. So from the liquid market price, we are able to infer what is the forward rate from June to September, looking at the 3-month future contract. Make sense? Look at the volume. It's huge. So these are IMM futures, which have very high liquidity. Okay, you can trust the price and you can infer the rate. You understood the rate. The rate is between June 3rd Wednesday to September 3rd Wednesday. Both of these rates are in future because now we are in month of May. but we are still able to see a forward rate. That is great. We can construct forward rate curve, 3-month forward rate from this date to that date. Okay. Similarly, September future, the rate is this. Sorry, the price is this. So what is the rate? Rate is 3.83%, I guess. 3.83% is the rate between September to December. Awesome, right? But if you look at this rate, if you look at this one, March future is not done yet. March future is between March to June. We are in the month of May. So this is a peculiar case where, what is the rate? Rate is 4.355%, I guess, right? 4.35%, 100 minus this. Yeah. That rate is between March 3rd Wednesday to June 3rd Wednesday. But now we are in month of May. So we are in a situation where we are partly realize the rate, which is fixed. And there is expectation. Let me show you the slide. It will make sense. So the first two cases that we looked at is this case, okay, where T1 and T2 are in future. June future is completely in future. September future is completely in future. Okay, so the rate that is sandwiched by that or implied or inferred by that contract is a pure forward rate. Okay, the next one, the March future that we talked about, that spans from March to June, but we are in May. Partly the daily SOFR rates have been realized, and the remaining part is the expectation. Okay, so the rate is a hybrid of realization and expectation. Okay, so we already know this part. It is published. So if we already know this, we can infer the remaining part. Correct? That will be also part of our yield curve. Yield curve is an expected rate for a future period, right? So that can be, so we can extract that rate from this particular contract and have an idea of what the rate looks like from today to whatever T2, whatever it is. And finally, this is a settlement picture. Okay. Once you reach June 3rd Wednesday, March contract will mature. March contract will mature, you will be due for settlement. And how do you calculate settlement? Well, you will have all the daily SOFR published prices, rates with you, and do a compounding and calculate the settlement price as we did in the Excel. So this is when the entire rate is realized and settlement price is identified. You cannot know the final settlement until you reach T2. Does this make sense? Any questions on this? This is important. This is the main sort of key idea that that you need to develop to deal with these SOFR products. Okay, all right. No questions. Let's move forward. I'll speed up a little bit. There's a question from Sarada. How did the settlement price differ from LIBOR-based pricing? See, the settlement price is already known upfront. At time T1, whatever is the 3-month LIBOR, that is fully known at T1. Right? So you are only waiting for the contract to get over. You know exactly the settlement price. But for SOFR, you are in dark, in dark until you reach T2. Okay? Yeah, so that's the difference. Right. Let's move to the yeah, we talked about this already. Yep. Let's talk about 1-month future. 1-month future is actually simple. There is no concept of contract month and delivery month. Is just a 1 month. So that is called as delivery month. Okay. So if it's a July future, it means the dates are simply all the calendar days in that July month. Okay. From first to last, 1st to 31st. These are the dates, start date and end date of the contract period for 1-month future. Okay. And how do you calculate the total rate for the 1 month? It is not compounded. It is simply arithmetic average. That's the key difference. Okay. I don't know why they did it this way. Um, yeah, but so let me zoom this. So let's look at a July 1 month future, right? It spans from 1st July to 31st July. And these are the dates, all right, till 31st. So when you have the SOFR daily rate published for all these dates, then what you need to do is simply calculate the arithmetic average. But here is the catch. The catch is for holidays or weekends, there is no rates. So what you do, you carry forward the previous rate. Okay, for example, July 4th is a America holiday. So the previous rate 5.06% just carry over. Okay, that's it. So identify the rates for all the days. If it's holiday, then carry it over from the previous known value and take the grand arithmetic mean. That's all there is. It's just the average of all the 31 days rates. Average is this. Round it to 1/10 basis point. So you get this. And settlement price is 100 minus this. That's the final settlement. 1 month over future. The key difference is it's for 1 month and you take the arithmetic average, not the geometric average. All right. So that's the key difference. So there's a question in hybrid expectation. Can you repeat the expected part T2, T2? Okay. So let me give it one more shot. Hold on. Actually, it's easier probably to understand from the actual data. So look at this. The March future, it spans from 3rd Wednesday of March to June, 3rd Wednesday of June. Right now we are somewhere in the middle of that contract. Do you agree? It's month of May, is between March and June. This price gives us an idea of the rate that is applicable for the entire future, which is 3 month future, right? So a 3 month rate between March to June is 4.455. That's the rate. That rate is for the 3 month period. But between March to May 1st, SOFR rates have been published. These rates have been published. So if we go back to the slide, look at this. From March, 3rd Wednesday, March to today, the rates have been published. The overall rate for the SOFR 3 month future is from March to June, but it is partly realized, partly known already. Okay. The remaining part is not known. If it is known, not known, then is always expectation. Whatever is not known or in future, there is an expectation. For example, a forward rate. Okay. That is an expectation of a future spot rate. Right. So the rate that is encompassed or captured by that particular future is a hybrid of what is realized and what is unrealized. The unrealized part is the expected rate for the remaining period. Take that, compound with the realized part, that serves as the hold rate between T1 and T2. I hope I answered your question. If not, we can talk offline. Just ping me, we can discuss. Okay. So question, is the expected rate published? No, it's not published. The expected rate is inferred from this future contract. So looking at the future contract, can I not infer what this rate is? I know the future price. That means I know this full rate, which is 4 point whatever that was. That is known to me. This is also known to me because this has been published by Federal Reserve Bank of New York. So what is remaining, I can easily imply from the future rate. That is the expectation. Everything is known. The full rate is known. This partial compounding is known. So what is remaining is the expectation that I can infer from the contract. And that should ideally be my term rate in my yield curve today. The yield curve that we construct every day, the rate between now and T2, let's say this is 3 months, not 3 months, maybe 1 month is realized, 2 months is remaining. Okay. So the 2 month rate, term rate or spot rate is exactly this. The 2 month spot rate in your yield curve is exactly this part. Okay, because if this is the 3 month rate, the 1 month rate is realized. What is remaining is a 2 month rate. That is the expectation, which is the spot rate for the 2 month tenor. And this is the exact idea which we will use to construct the yield curve. I don't think we can cover the yield curve in detail, but I'll give you a high level idea of what are the considerations you need to take. Okay. So yeah, we talked about 3 month futures, 1 month future. These are the two most liquid contracts. And if you go to SME, the floodgates of SOFR has opened up. Many contracts have been developed. There are SOFR options on SOFR futures. Okay, these are called mid curve SOFR options. What I want you to do is carry this fundamental idea of a backward rate. How do we use it in our valuation? So that was the main focus of today's webinar. So yeah, and if you look at on the FX side, right, we have FX swap, cross currency swaps, cross currency basis swaps. All these things are have been redefined to reflect SOFR and let's say ISTER. Okay, so you have to take into account all this. So today it's very liquid and very prominent. So take a look at their website. CME has a lot of useful educational resources. You can just read through them. Finally, in the next 5 minutes, probably, I will discuss the concept of term rate or the yield curve that you would be able to construct from the liquid futures. Okay. All right. So let me take you to the Excel directly. So one thing to note here is, so the central idea is this. We already actually have discussed this one. You can do without me explaining this, you can actually calculate it yourself if you understood the concept. Okay. This is the key idea. This is the key picture. There are SOFR futures floating in the market. Okay. Some futures reference a rate that is completely in future. Some future SOFRs are there where you're already in between some of these contracts, right? For example, the March contract. So using these SOFR contracts, can I not create get the idea of a term structure of rates? 2 month rate, 3 month rate, 5 year rate, 5 months rate, whatever, 6 months rate, 1 year rate. I can extract those rates which are captured by these future contracts. Correct? For example, this particular contract, right, will give me an idea of the 2 month rate. Whatever is remaining. That will be part of my yield curve, 2 month rate. We can extract from this contract. So normally when you construct a yield curve, you extract these rates from the liquid contracts, and then you come up with an interpolation scheme to do a continuous curve. Okay. So not going there. So pretty much you can use all those ideas. Just only one thing is, how do you extract the rate from these contracts? You have to use the idea of this hybrid concept. Okay. What is realized? What is not realized? Get the rate from there, which is on the real unrealized part, and then proceed with your yield curve construction. Question from Gaurav, possible, but is it possible with futures still 1 year beyond that? There are, I think, 11 calendar. Let me confirm. Did I close it? Oh, here. See, we have contracts still. So these are still liquid. Let me load everything. Yeah, here the liquidity is less. Probably I'll stick to this. March 2030 contracts are all being traded. 2030 March contracts are being traded. Also has good amount of liquidity. This is much ahead in future. Okay, but this rate that is between March, third Wednesday of March 2032, third Wednesday of June 2030, it's a pure forward rate, right? Much ahead in the curve. Yeah, 5 years they publish. Yeah. Awesome. Okay, let's talk about a few ideas of how CME actually comes up with the term rate. Okay, first and foremost, understand one thing. This is very, very interesting. It's an important uh, concept. If you look at the SOFR rates, right, day by day, do you see much fluctuation on it? 2.46, 2.46, 2.46. It's pretty much constant, right? Constant. Not a huge fluctuation. Like you don't expect a, like, I don't know, normal distribution or anything. It's pretty much constant. There's a few little variations here and there. But the key fact to note here is, hold on. Let me take you to the year 2023. Year 2023. Okay. So the SOFR rate is highly reactive to the FOMC dates. Okay. Federal Open Market Committee, they meet and they decide the rate policy, rate cuts or rate hikes, right? Thus, based on that outcome of that meeting, the SOFR rate jumps. Okay, so let me show you. If you go to the FOMC Federal Open Market Committee, right? Year 2023, for example, the committee met on January 31st and February 1st. Okay. What was the outcome of that meeting? Let's go there. So it says committee seeks to achieve maximum employment and inflation at the rate of 2%, blah, 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 blah. With these goals, committee has decided to raise the target range for federal fund rate to 4.5 to 4.75%. So they decided to raise the target. Okay. Before this, it must have been, so this is a 25 basis point raise. Okay. On which date? On 1st February, that was decided. Okay. Let's go back to the SOFR rates. 1st February, look at this. First till 1st February, this is all like constant, 4.31, 4.3, then not much change, pretty much constant, right? After that meeting outcome, on the 2nd February, there is a 25 basis point jump. Do you see it? So SOFR, the biggest driver for SOFR evolution is those dates, FOMC dates. There are jumps, okay, 25 basis point jumps. And then that continued, constant, pretty much constant, right? Until, let's look at another date. 22nd March. What happened on 22nd March? Meeting happened on 22nd March. What was the outcome of the meeting? To support these goals, committee decided to again raise the target range from 4.75% to 5%, again 25 basis point increase, right? So immediately that will reflect in the repo market. So if you go here, which date was it? It was 22nd March, right? So you would see that jump on 23rd. On 23rd of March 2023, from 4.55, there is a 25 basis point jump again. Okay. And again, that continued. So from a modeling perspective, if you want to, this is important, guys. So you can infer the rates that are inferred by the SOFR futures. It's very simple. But how do I predict the forward rates day by day? Like what will be the rate, say, after 1 month? Daily rates, daily overnight rates. We need a model that will be able to predict the daily rates going forward for all dates in future. Okay. And you need to calibrate those model parameters. So once you have a full forward rate model calibrated, then you can calculate the yield curve. Right? It's just compounding those daily forward rates to come up with term rates. That's it. So how CME does it is you need to identify the future FOMC meeting dates. So these are the dates that they are supposed to meet. Okay. On those meeting dates, right after that, right on the next day, there will be jumps. So I'm taking theta as the jump parameter. For each of those dates, there are jumps. In between these two dates, the forward rate is constant. Daily forward rate. Daily forward rate is like the expected overnight SOFR rate will be constant. That is my model. Simple model, because it's almost like a constant, right? Only jumps after the FOMC dates. So theta is just like the top up, the jumps that keep getting accumulated right after the FOMC meeting dates. These are published in advanced. Published as in the dates are known in advanced. So I can use that to model the evolution of my daily SOFR rates. Okay. So take that model. These are the parameters that solver will give you. What are we trying to minimize or maximize as part of the solver? Well, based on this model, what would be the realized overnight SOFR rates? You can calculate. Daily forward rate side, we have a model in place. Based on the daily overnight SOFR rate that is coming out of my model, I can easily value the SOFR futures. SOFR futures, which are like 3 years ahead or 2 years ahead. For that reference period, 3-month reference period or 1-month reference period, depending on whether you are using 1-month futures or 3-month futures, I know the daily rates from my model. Take those daily rates, compound them, or do arithmetic average, depending on which contract you're using, come up with the final price, right? 100 minus R. That price should match the current market price that I'm seeing on CME's website. These are the observed market prices for these liquid 1-month SOFR futures, liquid 3-month SOFR futures. These are the prices, observed prices. From my model, what are the rates I'm getting and what is the price I'm getting? That is here. And then take the difference, minimize square error. Minimize square error, that will solver will give me the values for these jumps. And my model is complete. Right? I have a fully calibrated forward model. I have an expectation of the future SOFR rates that will be published. So if you have that, then you can easily come up with a yield curve for any 2 dates. You can do a compounding. You have the value of or forecasted or predicted values of the future daily SOFR rates. Right? So that's it. So one consideration here I wanted to make is we add a regularization parameter. When you minimize the sum of squared error between the market price versus the fitted price is coming from our model. Okay. There is a regularization parameter we add so as not to. Okay, let me explain this particular structure. So you see this. Lambda is a penalization factor that we use. This is supplied by the user. It is not trained on the data, right? Depending on how much you want to penalize this. What are we penalizing? We are penalizing the squared jumps. Sum of theta squared jumps. Okay. Why are we penalizing sum of squared jumps as part of the objective function? Shouldn't the objective function be just match the model price with the market price as best as you can? Why are you penalizing sum of jump square? Well, the idea is the keyword. If you are asked in the interview or something, just say this word. Interviewer will be impressed. Policy graduation. Policy graduation. So if there is a jump, let's say there are two successive jumps on 2 meeting dates. The overall effect is a 100 basis point jump, for example, right? I can break that 100 basis point jump by, let's say, 90 and 10, or I can do 50 and 50. Both will have the same impact on the future rate, the forward rates, everything, right? Ultimately, you care about that big jump, right? So I would rather prefer 50 and 50 rather than 90 and 10. Okay. Policy graduation, the change in rate is gradual. It is not abrupt, like you do a 90 and then a 10. No, I would rather do 50 and 50. We saw the last 2 times it was 25 basis point, 25 basis point, right? So that's the reason. If you add this term and you minimize, it will try to minimize the jump size, individual jump sizes. Okay, still you'll be able to get the effect of 100 basis point jump, but in gradual fashion, not abrupt. And how much you want to discourage that big jumps is based on this penalization factor that you supply. You minimize this, get the values of theta are the jumps, and then here you have the forward rate curve and you have everything. Okay, this is the method that CME uses to publish the term rates. You can use any other model you want. Okay, but the key input here is the FOMC meeting dates. That's the key input, right? Because we see a clear pattern that SOFR rate uh, goes through those jumps right after those meetings. All right. So yeah, and then the entire yield curve infrastructure that you have learned before, right? Interpolation schemes, bootstrap, everything, all of those are still applicable, but you have to consider these additionally to do justice to the yield curve construction. Okay, so yeah, that's pretty much all what I had. I know probably it's a lot to take in, but two key elements that I want you to get out of this lecture to get to start exploring on your own. Understand how the backward rate works. Okay, and yeah, so picture the backward rate calculation, how it is different from the forward rate calculation, and then understand the floating rate calculation concept. These are the two key changes. Okay, and yes, there is impact to option valuations as well. For example, if you have like a cap rate, right? For cap rate, again, the rate depends on the floating rate minus strike price, whichever is higher, correct? But the floating rate would not be known until you reach the maturity. The expiry is not at T1, it is at T2. That is the main difference. Okay. All right. So that's all I had. Let me stop recording and we can discuss any additional questions you have.